Okay, well, hello everyone, and welcome to the popular General Insurance breakout session. My name's Chris Noone, and I'm an actuary at QBE. I'm currently looking after IFRS 17 Global Actuarial Compliance. And this is Rachel Poo, who is an accounting policy manager at QBE, and she's looking after our Global Accounting Policy IFRS 17 workstream.
Hi everyone, I'm Adam Cohen. I'm a senior manager at KPMG in our insurance audit department. So I have a lot of general insurance clients and starting to get more involved in the implementation of 17 with those clients.
My name is Gunn. I'm an audit partner at KPMG, work with Adam. I'm working with a number of clients across general insurance and life insurance with their IFRS 17 implementations. Before we get started, we did want to know who we have in the room here. So as part of testing out Slido to see if it's working, and also to give us a bit of background on who we've got here, because it's a large group, we have a first question for everybody. So if those of you that were here yesterday, it's the same code, which we might need reminding of. Has anyone got it there?
What's the code?
X469. So if anyone, hopefully most of you have Slido downloaded. Those of you don't, you might just have to work with your neighbour. Do you remember the website otherwise?
What's that?
Do you know how you get onto Slido? No, I think most people got it. Okay.
I don't, no.
We only had 7 responses, so I think there's a few more of you in the room than that. So keep going.
If someone can share the website and the code, that would be really useful.
Oh, okay. It's in your packs.
It's in the packs, yeah.
Is that a page? Is there a page number? Page 2. Page 2 of your packs will show you the website, and it's pretty easy to then get onto. 25 responses, so getting there. And a very heavy dominance towards preparers so far. Probably not all that surprising.
What's this doing?
Right. Most of you look like you've finished what you're doing. So anyone else still putting in their answers? Okay, give it 10 more seconds and then we'll have a look who we've got.
That's it, don't it?
Can I press this one?
Yeah.
Okay, we'll close this one there.
So I think that's the results, right? I don't think we can show it.
Okay, so we've got a few technology challenges, but we have 76% of you in the room are preparers, so probably not all that surprising. And then a mix of consulting firm, a couple from APRA, one from another regulator, and 9% are other. So I'm not sure what other is, but any others in the room want to say where they come from? We're not serving breakfast in here, so... Okay, that's really helpful to know. So at least as we get into the presentation, obviously we'll be focusing on sort of what we expect preparers want to know. And yeah, we'll go through it that way. So I'll hand over to Rachel quickly now.
Awesome. So we've thought we'd start by putting up on the slide the areas which we think are most impactful for general insurers. And the boxes with the purple stars are the 4 areas we were thinking of focusing on today. So there will be a little bit of repetition of the concepts that we went over yesterday, but hopefully we will deep dive into some of them and hopefully give you a little bit more of a practical flavor in terms of how we would actually do some of these things in practice and what are the key considerations we would have to think about when thinking about how to actually do this stuff. So the 4 things we're going to cover, just for completeness, are level of aggregation, so the portfolio definition and how we identify onerous contracts for PAA preparers in particular. The PAA eligibility test, which is something that we covered quite a lot yesterday, and now we're going to start talking about how we do the test, what does that mean, what are the things we need to think about. And we'll also talk a little bit about KPIs and what that could mean in the future for non-life insurers, and also a little bit about APRA and how they impact GI in particular. So before we actually go into the detail, we just wanted to take a bit of a pulse check. So another poll, just to see what people are thinking are the key areas that impact them the most. So I'm going to pass back to Julia to run the poll.
Yep, so it's another poll open. So we have assumed, well, we think there's 4 topics, but we do want to validate that with what you guys think as well. So are you thinking it's the level of aggregation and onerous contracts? Is it PAA eligibility, expense attribution, your reinsurance, acquired contracts, or your APRA reporting that you think is going to be the biggest impact for you? So back to Slido. Okay, since we haven't worked out how to get the results on the screen, I'll just confirm that the 67% of you think it is the level of aggregation and onerous contracts that'll have the biggest impact for you. And that's relatively closely followed by your reinsurance held, which we're not covering in this the session today, but there's a session later this morning that's purely on reinsurance, which is why we're not covering that here. Yeah. So, which Rachel's also involved in.
Also, we'll say reinsurance health is not just a problem for GI preparers; they're a problem for everyone. So,
yeah, and then actually APRA reporting and PAA eligibility are the next 2. So with that, I think Rachel and Chris will get into the technical.
That's right. So I think we saw a lot of questions come through yesterday around onerous contracts and PAA eligibility. So this will be a good chance for everyone to clarify some of those. Put the questions out there again, feel free, and we'll share from our perspective how we view those areas.
Also, feel free to shout out questions if you think Slido is a bit too slow, because we are doing a bit of a self-service technology management here, so feel free to shout. We have a smaller room than yesterday. It helps to make this session a little bit more interactive as well.
I've had a couple of questions come through on here already, or one actually, but I'll ask that at the right sort of time.
Okay.
Okay, fantastic.
So if people are too scared or have quiet voices, do feel free to put your questions into Slido. It's still open.
Okay, so before diving into the PAA eligibility, I thought I'd give an overview of the measurement models under IFRS 17. So IFRS 17 introduces 2 measurement models, the general model and the premium allocation approach, and also introduces new terminology. Now, everything below the grey line in this structure represents our past service, or as IFRS 17 calls it, our liability for incurred claims. This is what we refer to as our outstanding claims liabilities under ASB 1023. And anything above the grey line is for future service. And this is what IFRS 17 calls our liability for remaining coverage, and is our unearned premium reserve components under ASB 1023, or our premium liability components. So in measuring the liability for incurred claims, the 2 models are identical. We have a central estimate of our cash flows, which we discount for present value, and then we include a risk adjustment at a desired confidence level. That gives us our liability for incurred claims. And that's very similar to how our outstanding claims are built up under ASB 1023, albeit with some nuances. The liability for remaining coverage is where the 2 models greatly differ. The premium allocation approach, which we refer to as the simplified approach, takes our unearned premium and earns it over time, as well as our acquisition costs. That's very similar to how we do things under ASB 1023, albeit with some accounting bucket nuances, which Rachel will cover on the next slides. So the general model is where it gets complicated for measuring the liability for remaining coverage. We build up our cash flows in a similar way to how we do our incurred claims. We have our central estimate of cash flows, which we discount to present value. We include a risk adjustment, and then we have what's called a contractual service margin, which represents our unearned profit. Now, this is our cash inflows less our cash outflows. And if the contractual service margin is positive, i.e. we have profits, we earn this over time according to a different pattern of recognition to what we would do on the premium allocation approach. If the contractual service margin is negative, we have to take that loss immediately through the P&L. So the premium allocation approach doesn't have a contractual service margin. The unearned profit is implicit, it's baked in to the unearned premium. So that's where we do an onerous contract assessment, which I'll cover a bit later on. You'll be familiar with the liability adequacy test under ASB 1023, which is how we check whether our unearned premium is sufficient to cover our cash outflows. So the premium allocation approach, very much a simplification for the measurement of the LFRC, which is why premium PAA eligibility testing becomes important. The general model, as we've heard over the course of the 2 days, is a lot more complex, and therefore there are more disclosure requirements under the general model. And I mentioned the onerous contract test in the premium allocation approach is based on facts and circumstances, which is a different way to how we build up our onerous loss compared to the general model. And we'll cover that a bit later on in the presentation.
Okay. So we've talked a lot about concepts, and we thought that it might be useful to bring to life some of these concepts by walking through an example of how the PAA works and comparing that to what we do now under 1023. Hopefully this will help to make it clear why people keep saying that the PAA is similar conceptually to what we do now under 1023. So here I've put out a really simple example. One insurance contract issued on the 1st of July. It's 1 year. We've charged the policyholder a premium of $1,200, and just to keep things simple, is all due at the end of the year. We've got acquisition cash flows of $180, which are paid on the same day, on day one, and the contract's not onerous. So I've ignored discounting because the coverage period is 1 year or less. Okay. So to be clear, I'm just trying to show you what the LFRC looks like, so the remaining coverage component. So the equivalent under 1023 is what we do with our unearned premiums. Chris will talk a bit later about the LIC. Okay, so what do we do today? What we would do today is, because our cash is received right at the end, we would set up a premiums receivable balance on day one of $1,200. We would also set up an unearned premium reserve of $1,200 on day one. And we would have a DAC asset of $180. So throughout the coverage period, the receivable stays as receivables because we haven't received the cash. And when we receive the cash, we de-recognize those receivables and we recognize cash at the end. So you can see on 30 June 20X2, you've got cash of $1,200 but no receivables balance. Our unearned premium reserve, we amortize, and I've assumed a straight line pattern for simplicity over the coverage period. And we also amortize our DAC. So what will we see on the P&L? In our P&L, we will see earned premiums of $300 per quarter. And we will also see our DAC amortization as an expense of $45 per quarter. So this is current accounting. This is what we do now. You will see all those balances on the balance sheet and the P&L. Now compare that with what we have to do in the new world. So I've used all the terminology that IFRS 17 uses to describe how we measure the LFRC of the PAA. So it's the PAA LFRC is measured as the sum of premiums received, less any amounts recognized as insurance revenue, less any insurance acquisition costs, and less the amortization of insurance acquisition costs in that period. So let's follow that process. So premiums received, 0, because we haven't received anything until the end. So 0 up to 30 June 20X2. We know we've got acquisition cash flow, so I've put that in of 180. So what happens next? So amounts recognized as insurance revenue, that's effectively earned premiums, similar. So we've earned 300, so therefore we reduce our liability by 300 in each quarter. Similarly, we amortize our DAC in the same way, so 45 in each quarter. What we will see in the balance sheet under IFRS 17, however, is just that closing balance of insurance contract assets / liability, one line. of 180 at the beginning, 435, 690, and 945, and then 0. Insurance revenue in each period is 300 in each quarter, which is our earned premium equivalent, and the insurance service expense is our amortization of that of 45 in each quarter. Caveat here, this example is really, really simplified, so it doesn't have any of the complications that impact our insurance revenue and insurance service expense line. I'm just trying to show you the mechanics of the PAA calculation. Okay, so now let's compare the two. Okay, so have a look at the total line. So sum of insurance line items on the balance sheet under 1023, and the closing balance of our insurance contract asset liability under IFRS 17. They are the same. What this is trying to show us, and what I'm trying to say, is that actually we can achieve the IFRS 17 PAA LFRC by using the amounts and balances that we do today under 1023. Because even though IFRS 17 requires premiums received to be used, we can use the net of UEP and premium receivables as a proxy for what that premiums received balance is. A big difference is in what you then see on the balance sheet, which is, Chris.
Sorry.
Which is those 3 lines under 1023 versus the 1 line under IFRS 17. So I'm going to pause there just to give you a few seconds to have a look at the numbers and the comparison. Again, caveat, this example is very simplified. It doesn't include any weird terms like commissions, no coverage period considerations, expenses, and all of that stuff.
So you can also see from the bottom 3 lines within each of those boxes.
Or not.
Technical. Okay, so you can also see in the bottom 3 lines in each of those boxes that the earning of our components is identical. And so that's why we would say that the measurement is very similar under both models. And if, in this example, it's identical.
I think it's also, worth just noting that that is an asset through the period because the
Yes.
premium receivable is in there.
Yes.
And so whilst you expect maybe your own premium to be there as a liability, it's actually sitting as an asset given the receivables in there too.
So when we get to portfolios, we will explain why that is significant. So just note, it is an asset in this example.
So high-level takeaway, there's lots of bucket movements, but everything in terms of measurements is very similar. And there is a display component which we'll go through on the balance sheet.
Yeah.
So the premium allocation approach, we talk about it being very similar to ASB 1023. However, it's not the same because there are some nuances. First of all, discounting. We're used to discounting our liabilities under ASB 1023. We use risk-free rates. Whereas IFRS 17 explicitly introduces the concept of an illiquidity premium. IFRS 17 argues that insurance liabilities are inherently illiquid, whereas our risk-free yield curves that we use to discount our liabilities are considered liquid. So therefore, we need to be able to discount our cash flows like for like. Now, IFRS 17 says that we can use 2 ways to calculate our illiquidity premium, our adjustment to our yield curves. We can use a bottom-up approach or a top-down approach. The bottom-up approach involves a risk-free rate plus the liquidity premium, whereas the top-down approach starts from a market reference portfolio of assets and then removes the risks inherent within the liabilities, not inherent within the liabilities. IFRS 17 does not mandate that we choose the top-down or the bottom-up approach, nor does it say they'll produce dissimilar results. In fact, it says that they will produce immaterially different results. We're also not required to prove that they're different. So the choice is yours, bottom-up approach or top-down approach, in terms of what works for you.
Chris, I've got a question come in. Is the illiquidity premium a percentage or a dollar value?
That's a good question. And in terms of the how and how you apply the liquidity premium, that's still out there for debate. I've seen percentage approaches in terms of a percentage adjustment across the yield curve. It's whether that could be flat across the yield curve, whether it should apply differently to different currencies, or whether it should vary across the yield curve. Now, the illiquidity premium that exists in life insurance has a reducing illiquidity premium as you go across the yield curve. So,
Chris, is it fair to say that the industry is basically watching to see what others are doing on the illiquidity premium piece?
Yeah, I think that's very fair. I think that's going to be one that we have to wait to evolve, and hopefully APRA might be able to give some guidance to general insurers in this area. So we won't heckle them right now, but.
Can I just jump back to the previous slide as well? And we did have a question just saying, is that disclosure under this AASB 17 format required, as opposed to being able to actually continue on the old basis?
On the face of the balance sheet? Yes, so on the face of the balance sheet, as you saw in the presentation session that EY did yesterday, it's just that one line, insurance contract asset and insurance contract liability. So all you will see under IFRS 17 is that one closing balance line. However, that closing balance line is going to be split up in the roll forward disclosure tables in the notes. But it won't be split in the way we see it today. So it's not going to be premiums, receivables, unearned premiums. This terminology is gone. It was going to be split up in a different way.
Thanks.
Happy? Okay, so moving on from discounting, we also have some changes within the risk adjustment area, what we used to call the risk margin under ASB 1023. IFRS 17 requires gross and ceded risk adjustments, whereas ASB 1023 tended to focus on net. And now there's another complication out there with regards to the gross risk adjustment. The gross risk adjustment is required to reflect the effect of reinsurance if it's considered in determining the compensation required. So therefore, the gross risk adjustment isn't necessarily a pure gross risk adjustment, nor is it a net risk adjustment after it's allowed for reinsurance. So the gross risk adjustment is effectively a hybrid. And this is an area which the industry is working through in some detail. And in terms of the how of calculating the gross risk adjustment, there are various papers out there. I think the ASB TRG Reinsurance Working Group has been involved in producing one of those.
Yeah.
And then as well, diversification benefit can be reflected in the individual entity risk adjustment if that's how the entity prices. So this is where you can allow for the benefit of diversification, say on consolidation, if you have a parent and therefore you are the subsidiary, you can allow for diversification in your risk adjustment if you consider it in your pricing. And then, of course, we've spoken a lot about onerous losses. We have a LAT test under ASB 1023 in order to check the sufficiency of our unearned premium, whereas IFRS 17 introduces this concept of an onerous contracts test, which is expected to be a more granular level than the liability adequacy test. It's also got other nuances, it being on a gross basis. IFRS 17 considers gross and reinsurance cash flows separately. We'll come to onerous losses a bit later on.
Chris, a question on that, although you defer it to later if you want, which is obviously refers on the slide to attributable expenses, but the question is what kind of expenses do we expect that to be that can be included, or that have to be included?
Sure. Well, IFRS 17, I guess, is a bit more explicit in terms of what expenses are not attributable. However, there are grey areas in terms of overheads, in terms of what overheads will be attributable to the insurance contract. Rachel, do you want to elaborate on that?
Yeah. So the standard definition of what's attributable is quite broad. So it has to be directly attributable to fulfilling insurance contracts, to be included in your insurance liability, and therefore within our insurance result. The standard tries to give some guidance, so there is an appendix, there is a paragraph B65 in IFRS 17 that gives you like a list of things that they expect to be attributable and things that they expect not to be attributable. Having said that, I wouldn't say the list is very prescriptive or very detailed because it does have a line that says overheads that you can attribute to fulfilling insurance contracts are attributable. So there is an element of judgment there, and I think the practice is also still going going through this process of trying to work out what that is. So 2 things on attribution of expenses. One observation is that currently lots of non-life insurers put most of their expenses through their underwriting result today. How much of that needs to be kicked out? That's the exercise that has to be worked through. And I guess the second observation is it's a balancing act, because the more we attribute to our insurance expenses, the more that impacts your onerous loss calculation, because when we have to project our present value of future cash flows, those present value of future cash flows includes attributable expenses. But then on the flip side, to the extent we don't include attributable expenses, like we classify more expenses as non-attributable, you will see them more clearly as a line in your P&L outside of the insurance result. So it's a balancing act, and I think it's fair to say that people are still in the process of working out how much is in versus out. And like the liquidity premium, we're all looking at others in forums. We're still asking each other, have you guys done that yet? And what does that look like? Because we don't want to be outliers.
Yeah, I guess just to add another point on that, in terms of when we calculate the liability adequacy test under ASB 1023, the actuaries do currently allow for certain attributable expenses in the premium liability calculation, and this premium liability calculation also goes to APRA. So the attributable expenses concept is not completely new from an insurance perspective. It's just more explicitly called out here, and they will be explicitly called out on the P&L where you have non-attributable expenses as a line item.
I guess I didn't actually answer the question directly. I realized. So what kinds would be out? So the standard says some product development costs are out, some training costs are out. It also calls out wasted labor. So read into that what you will. That's out. Yes.
Can I ask, the gross risk adjustment for onerous losses, is that the same gross that you do for your other risk adjustment, or is it something?
It is. It is. Yeah. Yeah.
And one other question on the onerous losses. We say more granular than the LAT. The question is, how low do you go?
Yeah, I think that's a good question. I think I will defer that until a bit later on in the presentation when we cover facts and circumstances in a bit of detail. But that's a great question, and it's something that causes a lot of uncertainty in conversation. So I think I'll miss out expense attribution there for now. There are some other model variations. We have obviously a different treatment of outwards reinsurance. IFRS 17 treats gross and ceded cash flows separately. And there is also an allowance for reinsurance bad debt within your reinsurance cash flow. And there's also some issues when it comes to retrospective reinsurance covers and acquired contracts. And I'm not going to go into any detail on those here, but if anyone's interested, please do ask at the end. So PA eligibility. What does the standard say, Rachel?
So we've seen this paragraph before. Yesterday, this got put up. But I thought it's always a good starting point because the starting point for thinking about how to put things into practice is always, what does the standard tell us? What does the requirements say? So an entity may simplify the measurement of a group of insurance contracts using the PAA. So the may suggests, I think we can go to the next one, suggests that it's optional. So you don't have to apply the PAA, but if you can apply it, I guess it's operationally simpler, but you can still, even if you can apply the PAA, you still have the option to choose to apply the general model if you wanted to. So then it says in paragraph B, the coverage period of each contract in the group is 1 year or less. So if you have a coverage period of 1 year or less, that's automatically PAA eligible. We heard yesterday that coverage period is not necessarily the contract term of your policy, so watch out for that. But if it's 1 year or less, automatically PAA eligible, happy days. If not, paragraph A would apply. So if it's more than 1 year, provided the entity reasonably expects that using the PAA would produce an LFRC that is not materially different from the general model LFRC, we can apply the PAA, and that is the test.
Okay, so just translating that quite simply into a flow diagram, and you'll have seen this before, but with the starting point is the coverage period of the contracts. We've mentioned that if the coverage period is less than or equal to 1 year, we're automatically eligible. Otherwise, further assessment is required. Now, there are some practical issues we need to consider. Now, I won't go into great detail around the coverage period and the contract boundary because we saw some good examples yesterday on those. But essentially, the key point is that it's not simply the inception date versus the expiry date of the insurance policy contract. You have to consider the starting point of the contract boundary and the end point of the contract boundary. And I think the examples yesterday illustrated that well. So then when it comes to the assessment, where we reasonably expect that the measurement of the PAA LFRC will not differ materially from the general model LFRC, there are a number of things that we'll need to consider that I'll go through on the next slide. How do we interpret reasonably expects? How do we define materiality for PA eligibility testing? And how does this relate to financial statement materiality? And I'll also cover what are the drivers of differences between the PAA and the general model.
Chris, we've also got a question as to...
In fact, I'm going to start there. Oh,
sorry. Also got a question as to what level you need to do the PAA eligibility testing. Is it contract or by group or by portfolio? So if we can pick up on that as well.
Well,
Shall we start with the standard?
Let's start with the standard, yeah.
Sorry.
So to be eligible, the group of contracts need to be eligible. And we'll talk about what groups are when we get to level aggregation, but just know that IFRS 17 has a certain definition of what a group is. So standard says we can apply the PAA if may simplify the measurement of a group of insurance contracts using the PAA if we meet these criteria. Now I'm going to pass back to Chris to say how this would apply practically, because really, does that mean we have to define our groups before we can do a PAA test? What if we haven't defined our groups, etc.? So.
Well, in terms of carrying out your PAA eligibility testing, you could be looking at your product classes across your company, and in terms of what are the contracts within those product classes that are most likely to fail PAA eligibility, and then you could do your testing on that basis. And then as you aggregate up to groups of contracts that if you've tested and passed the worst case scenarios, then you're more likely to pass as you aggregate up. So there's a choice there in terms of what level you do the testing. You obviously need to get comfortable with the PA eligibility testing. It's worth, I'm using the word testing here a lot, and it's worth noting that the standard doesn't actually use the word testing. And that's why I'm just going to cover some of the drivers that do affect PA eligibility, because I think it's really important to really appreciate what really we're talking about when we're talking about the difference in measurement. So the general model and premium allocation approach essentially differ for the measurement of the liability for remaining coverage. And we can break that down further to it being the way they recognize profit. They each earn profit differently. The general model has a contractual service margin, which it recognizes according to a coverage unit pattern. And the premium allocation approach recognizes profit according to an incidence of risk or an earning pattern. So to the extent those two patterns are different, i.e. the two models earn their profit differently, we're going to get bigger differences between the measurement of the LFRC. So that covers the first point there on the slide. The second one, significant cash flow variability. The general model requires us to reassess our assumptions at periodic time components. So therefore, to the extent that our cash flows are more volatile, we're going to have more volatile unearned assumptions that are feeding in, whereas the premium allocation approach just earns off your premium over time. So to the extent that there's more cash flow volatility, we're going to get greater differences between the two LFRCs. Under a long coverage period, this is going to exacerbate some of the issues. For example, we're potentially going to have more cash flow variability and more variance in unearned assumptions over a long coverage period. There's more chance for our pattern of recognition of earnings under our PAA to differ to our coverage unit pattern under our general model over a longer period. Conversely, if we've got a short coverage period, we know that we're automatically eligible if we're under 1 year. And a long coverage period is also going to exacerbate differences in our discounting, because the general model CSM locks in discount rates, whereas the premium allocation approach does not discount the LFRC. So we're going to get some differences there. And then high profitability, I like to use this one last because profitability can change, but essentially the higher your profit that you're earning differently under two models, that's going to exacerbate any differences between the two models. So I like to think of these four as the key factors to what is going to cause a difference between the two model LFRCs. And I think this is a great starting point before diving into really detailed low granularity testing, so that you can actually appreciate and understand what drives the difference between the LFRC.
And I think the length of the contract period is one where we get a lot of questions on, and people are like, is there a hard and fast rule? If I have a contract that's 3 years, 5 years, will I be able to get into PAA? And to be honest, I haven't seen a clear answer on that yet. There's so many different views, and it's not until you run the numbers where you really actually understand where you're going to fall.
Yeah, and it's worth noting that we've seen, based on these factors and based on a range of testing, we've seen PA eligibility extending quite far in terms of contracts of even 10 years passing PA eligibility. Because ultimately, the long coverage period isn't everything. If your pattern of recognition is very similar to your coverage period, or if your volatility of cash flows isn't too high, you're going to have a similar LFRC. So it's not simply about the coverage period, and I think everyone focuses on that, given the standard says less than 1 year and greater than 1 year
I think
testing.
as Chris said, the coverage period just makes all of these differences bigger.
That's right, yeah. So you're more likely to fail. Okay, so diving a bit deeper into materiality and how we should be thinking about materiality when we're doing PA eligibility assessment. This paragraph from IFRS 17 says that the entity reasonably expects that such simplification, i.e. applying the premium allocation approach, would produce a measurement of the liability for remaining coverage for the group that would not differ materially from the one that would be produced applying the general model. So what does that materiality difference mean? So I've put a bit of a schedule here in terms of how the premium allocation approach and the general model LFRC might look at each year across the coverage period. This is what might be an output of our PA eligibility testing model, say. We have the PAA LFRC and general model LFRC at each point in time, but how do we assess if the differences between them are material? Do we look at an absolute threshold? We decide an absolute threshold and say that the general model LFRC less the premium allocation approach LFRC, if it's less than a certain amount, are we PA eligible? Or do we look at a percentage threshold? Either a percentage at each point in time or a percentage of the LFRC at inception. Now, I wouldn't mind asking the question of our auditors here in terms of what other factors or other possible methods of materiality you may have seen in the market, and perhaps we can open up that to the room if anyone else has seen anything else.
I think, to be honest, what you've covered here is, whether it's an absolute threshold or a percentage are what people are looking at. I think what I'm seeing, most people are starting with a percentage, but as an auditor, we're coming back to, but a percentage on a very large contract or group of contracts, you need to be careful that you do have that in our mind, although still working through it, you've got to apply an element of financial statement materiality as well. If it was a smallish percentage, but on a very large numbers, obviously that could be quite material to the financial statements as a whole. So I think it is, in my mind, it's both. It's a quantitative, it's a percentage and probably a dollar amount too. Yeah. So, but as I say, we are still working through it with clients. It's a sort of fairly key discussion at the moment, just as people are actually working out, do they need to build a general model or can everything get into PAA? Because certainly if you got to the point where there was a risk in the future that the dollars could be very high in terms of the differences, even if it was a smallish percentage, then there's some risk there about then needing to change sort of the way you're approaching things.
Yeah.
And would you consider materiality from a qualitative basis as well as a quantitative? So forgetting about the numbers, if that entity was close to breaching its debt covenant it was only just making a profit, would that sort of stuff come into it as well, rather than just the number?
Yes. In my mind, I think you always would need to consider qualitative as well as quantitative. So, yep.
Now would probably be a good time to refer to the ASB practice statement on materiality, because that is a really good reference point, which gives guidance on how we think about materiality when preparing our financial statements. So that's quite a good reference point. Having said that, we did say the test is not done at the whole of financial statements level, so you can't really apply that high materiality to each contract that you test. So we think of financial statement materiality as sort of the second threshold, the second gateway almost. So the testing materiality is lower, and then once we've tested everything in aggregate, decide whether there is material at the differences are material at the financial statement level as a whole. A key consideration in how we do use financial statement materiality as well is, for example, say we fail the test on that lower materiality threshold. We might still choose to apply the PAA, not on the basis that we passed the PAA eligibility test, but on the basis that actually the impact of using the other model is not material to the financial statements. So it's not irrelevant.
I think I'd agree with all of that as an auditor, and it was more coming from we can't forget financial statement materiality. So if everyone's working with percentages, and it's not a significant percentage of the LRC, etc., just don't get too far away from the fact that it could still be material to the financial statements. So, yeah.
And your APRA returns as well. And capital, we always look at 5% of capital as a general. It's not a hard rule, but if it's going to impact 5% of capital, I think on your APRA returns, you're probably going to have a problem.
Sorry, just want to ask, in terms of like consistency in applying the national, can you change from one model to another without breaching any provision in the standards? Like say, in 1 year I use PAA and then suddenly circumstances change, I'm going to use GM.
For the same contract?
Yes.
I guess this is a good point to cover when and how often you should do PA eligibility testing. So PA eligibility testing is for the inception of a group of contracts. So once you've assessed whether that group of contracts is PAA or not, for that group of contracts you will continue to apply the PAA. I guess the conversation comes as to when it's a new inception group of contracts.
So two things. For any new contracts, so not that one that you just tested, if you may have to retest, you can choose to apply a different model. But for the one that you've tested, you test at inception and that's it. But I will flag the contract modification term. So if your contract is modified, such that because of the modified terms, you would no longer be eligible to apply PAA eligibility, then that would fall within contract modification. You may have to actually de-recognize the contract and recognize a new modified contract and start again effectively. Does that answer your question?
Yeah.
And there's a question here about, other than modification, is there any other time you'd change from PAA to GM halfway through a contract?
Not that I'm aware of.
So you would, I'm not aware of anything that would make you change your model halfway through a contract.
So
I think once you've assessed
at the beginning, and then you stay in unless
Yeah.
you change the contract.
Because paragraph 53 does say you can apply the PAA if at inception A, B.
Yeah.
I got a question. So in order to meet 5-year time frames and so on, is there a reason why you wouldn't worry about that if you think that you're willing to test it every year and just build a general model?
You can build a general model by all means. It's an optional under the standard in order to apply PAA. Those will be applying PAA will be those thinking that it produces a simpler outcome operationally, and they are allowed to.
But you still need to build a test every year for groups of contracts.
It depends how much your groups of contracts or your business is changing from year to year. I don't think it's necessarily mandating that you need to then go and test those group of contracts every year.
Yeah, I guess we're coming down into more practical territory, which is, I suppose, an entity by entity decision. But one of the things to think about is if your new product, say you've tested a particular product or group of contracts, and your subsequent groups of contracts that you issue for the same product are exactly the same as your first group that you've just tested last year. If that first group passed, is there any reason why any new groups that are identical wouldn't pass the PAA? So that you've got to think about that. And then, so in order to determine which new products you would actually do the testing for, it's just a sort of one of the practical considerations.
And these are all the things that would inform your accounting policy.
So can we then assume that once you tested an annual cohort, so say you've got an annual cohort, you've tested 2022, and you've worked out that it's okay to go PAA, it's a set and forget?
Yeah.
Not sure that would go down very well with your auditors if you forget it forever. I guess you just have to decide how often you want to re-review that test that you did. However long.
Cohort.
Yeah.
For that cohort is done in terms of set and forget.
Oh, yes,
done
yes.
this
So
one.
2022, you
2022, all good, yeah.
Yeah.
2023, if
Yeah,
you've got
yeah,
no
yeah, yeah.
experience to indicate that it's different, then you might be able to get away with relying on the 2022 testing.
Yeah.
If there's anything that's different and has changed, then you'd have to revisit.
So I'll move on to, I guess, the next interpretation wording around that paragraph, which is the wording around reasonably expects. So what do we mean when we say reasonably expects that such simplification would produce a measurement of the liability for remaining coverage that would not differ materially? So if at inception of the contract, we expect significant variability in the cash flows that would alter the liability for remaining coverage as measured under both models, theoretically, that would result in us failing PA eligibility if the difference between the LFRC ends up being material. So what are the types of scenarios that you can consider in your PAA eligibility testing? Well, this goes back to the drivers of PAA eligibility. And I mentioned that profitability is one of those, where if we've got higher profitability, we're more likely to fail because we've got more profit, which we're going to be earning differently under the two models. So we might want to stress our loss ratio. We might want to put an improving loss ratio through our model or a reduction in our expense ratio through our model. I also mentioned that the time-dependent patterns, the coverage unit pattern that's used to amortize our profit under the general model versus the incidence of risk or earning pattern that amortizes profit under the premium allocation approach, result in differences. So we might want to stress our coverage unit pattern. Similarly, for the discount rate under the general model, we might want to change our payment pattern and see that how that affects the differences between the premium allocation approach, which has got an implicit discount, so therefore isn't discounting explicitly, and see what differences come out. So the key thing here is reasonable, right? Reasonable scenarios. It's how we reasonably expect things to change. So this implies that we shouldn't have to consider remote scenarios. So any more questions on PA eligibility coming through before we move on to the next section?
A few.
Yeah.
You go.
Can I ask, I can't remember, does the standard specify how often do you need to do the testing? Like whether it is enough to do it if you have, for example, 3 years coverage, whether you just need to do it at the inception or during the time, like every year?
Yeah.
Shall we go back to the requirement slide, 53? Yeah, this is a common question, actually. So I bolded at inception on purpose because the standard says you can apply PAA if at inception you pass those tests.
So that raises a question, if something unexpected happens, like with the cash flow during the period, and that would basically throw me off the PAA eligibility, I don't basically reassess anything
No.
with the PAA.
No.
The other thing to highlight is actuals. Actuals don't actually affect your LFRC because so if something happens, it goes straight to P&L anyway, so it doesn't affect your future coverage.
But if that was to affect your view on what would happen in the next inception group of contracts that might result in a material difference between the two models, that's when you would go and assess for the new group of issued contracts. Yeah.
One more here, in fact two. The first is annual cohorts. Do we assume it's the financial year or inception date or financial month to do the testing?
We tested at a contract level.
Yeah.
Most people would do, I guess you don't need, I mean,
it says inception, right? So it's theoretically, it's the underwriting year, it's when the contract incepts.
so it's one, yeah.
Yeah.
And one more, but I'll ask, if you choose to do the general model only, do you need to even think about your PAA eligibility testing?
No,
No.
not at all.
If you have determined that you're eligible for PAA for one group of contracts, but then all future group of contracts you're not eligible for, something has changed, so you have to apply a general approach, can you then go back and change that original group to general so you have to deal with two different models?
No.
Even though they shouldn't result in materially different results, because that's what we was added in the first place.
Well, I guess we're not looking at anything retrospective here. I think so. For that first group of contracts, that was determined to be PA eligible, and you chose to therefore apply PA eligibility, and therefore use your unearned premium and DAC approach. And then for the new group of contracts, you've chosen. Well, you've had to use the general model because you failed the PA eligibility testing, and for that group of contracts, you move forward on the general model. So there's no retrospective readjusting or anything like that.
Is there any specific disclosure required for that? Like, let's say
If you change.
If you are doing the PAA
Yes.
fraud, but if basically something unexpected happened and you have to recognize it in PLM, is there any specific disclosure required to say basically that, okay, this was unexpected and realized through PAA?
Not so much, but in your disclosure tables, you will see that movement going through your P&L. Yeah.
Yeah.
And we have to disclose separate tables for PA and general model anyway, so it's quite clear.
Sorry, forgive my limited knowledge about
No,
the
it's okay.
standards and also the prudential standards for the valuation. Was there any difference between the PAA GM model from ASB 17 perspective compared to the prudential standards?
You mean APRA?
Yeah.
APRA, APRA's only just issued their indicative directions, so there isn't really a APRA version of the calculation.
No, not.
At least nothing that's come out to say anything about it. So APRA has said that for APRA reporting forms, we can just use the basis that we use to do our ASB 17 reporting. So that, I guess, that assumes exactly the same as what we would do on a statutory basis. Is that fair?
I'm asking the question because I'm coming from a tax perspective question, where for tax purposes you have to follow the valuation from the actuary, which I assume the actuary is using the standards provided by APRA, but accounting side we're using the PAA and GM.
Well,
Some differences.
well, no, the actuaries do have to apply with both standards. Yeah.
Perfect.
Yeah.
Thank you very much.
Yeah. But yeah, I think there's a session on tax, is there, a bit
this
later on as
afternoon
well,
there's a
which should
tax session.
hopefully clarify some things there.
I think I've covered all the questions on here relevant to this section, but if I've missed any, then put your hands up or...
And feel free to come and grab us after. Otherwise, we can revisit PA eligibility at the end if we have time for some more questions.
Okay, level of aggregation. We had quite a lot of questions on this yesterday, and I think a few today as well, this morning. So hopefully this bit will help to clarify some of those. So a bit of a recap. IFRS 17 talks about two levels of aggregation, the portfolio and groups. And I'm going to try and explain here what the difference is and why each of these levels are relevant. So IFRS 17 says we have to determine our portfolios of insurance contracts, and portfolios are determined are defined as contracts that are of similar risks and managed together. I'm going to come back to that definition a bit later on and talk a little bit about how that could apply for non-life products in a bit. So within a portfolio, we then have to divide that portfolio into groups of contracts. So group sits under portfolios. And the standard says we have to decide if we have within a portfolio groups of contracts that are onerous, and separate them from groups of contracts that have no significant possibility of becoming onerous, and separate them from everything else. Now, in practice, for non-life, and Adam and Julia might interject here, we think it's possible that non-life insurers are probably going to move towards a binary application of these groups, so meaning onerous or non-onerous. And the non-onerous being one of these no significant possibility of becoming onerous bucket or everything else bucket. Now, one important thing to say about groups is the annual cohorts, which is the standard says a group of contracts cannot include contracts that are issued more than 1 year apart. So remember, it's not about how long the coverage is. We don't have to break a 3-year coverage contract into 3 groups. It's about inception, issue date. So if in a group of contracts, the first contract in the group was issued on the 1st of January, the last contract in that group cannot be issued later than 31st of December that same year. So that's what it means. So you can have 10-year contracts, 20-year contracts also in the same group, but they have to be issued within 1 year from each other. And the reason they came up with that requirement is because they didn't want people to be releasing CSM for indefinite periods. So they capped it at 1 year, so anything issued within the year, that's fine. You can release your CSM over whatever that coverage period is for those contracts, but then you start a new group for the next cohort. So that's why they did that.
If you have a binder, is it the inception date of the binder that counts? So you could write lots of policies under that binder and go on.
It depends which is the contract, the binder or the policies that sit under it. So the second thing I wanted to bring out on this slide is why and how the 2 levels of aggregation are relevant. So the portfolio is, and Chris will talk about why, it's the starting point for identifying our onerous contracts. So that is not the onerous contracts. Remember, the onerous contracts have to be identified and measured at the level of the group. So the onerous contracts is a group that sits under a portfolio, but for PAA, because of the facts and circumstances requirement, which we'll talk about on the next 2 slides later, we start from the level of the portfolio and we decide whether there are onerous contracts that sit under there, and if they are, those onerous contracts are a group. And then we split them by annual cohorts. It's also important for balance sheet presentation, and I'm going to pause there because on the next slide I'll give you an example of why. And this was a tentative decision that's still in the exposure draft, and we're waiting for them to finalize that decision when they issue the new standard, hopefully in June next year. Okay. So balance sheet presentation. Why do portfolios matter? Remember I said in the example, note that the balance is an asset balance, and this is why it matters. So per the exposure draft, we have to separate portfolios of contracts that are assets from portfolios of contracts that are liabilities, because if they're in an asset position, those portfolios need to be put on the asset side of the balance sheet, so the top, the insurance contract's asset, and if they are a liability, they have to be put in the liability section of the balance sheet at the bottom, the insurance contract's liability. Now this used to be, or this is currently in the current version of the standard, by group. So meaning we have by annual cohort, we have to know whether it's an asset position or a liability position and split them into the 2 buckets on the balance sheet. Now the exposure draft has raised this as a result of lots of lobbying from the industry to portfolio, which is great. What that also means is that at a higher level of aggregation, we are probably less likely to have insurance contract assets. We're more likely to have insurance contract liabilities because we will have a bigger liability tail compared to the newer cohorts, which may have a bigger premiums receivables element to it. So I'm going to just talk to an example because there's I've just said lots of words. Again, some numbers on the slide there. I've said, okay, let's say an entity has two portfolios, one in a liability position of 200 and one in an asset position of 100, and that's made up of 3 groups each. Remember, a liability position doesn't mean the contract's onerous because our outstanding claims, our UEP, and all of those components are liabilities. So that doesn't mean it's onerous. So now, what will we see on the balance sheet if those are our balances at the end of a reporting period? We will see this by portfolio. So because portfolio 1 is a liability of 200, we put that in the liability line, insurance contract liability 200, and portfolio 2 is an asset of 100, so we'll put that in the asset line, 100. Okay? Okay, now let's get into the definition. So similar risks and managed together. How do we define our portfolios? So the standard says a portfolio is comprised of contracts that are similar risks and managed together. What are similar risks? And the standard tries to provide some help to allow us to interpret what they might have intended. And by doing that, they've said contracts in different product lines are not expected to have similar risks, and therefore they're not expected to be in the same portfolios. But they didn't actually say what they mean by product line, and neither did they say contracts in different product lines definitely do not have similar risks and cannot be in the same portfolios. So how do we read that? So they gave specific example. They gave one example. They compared a single premium fixed annuities product with a regular term life assurance product, and they are very clearly different products that are common in the life space. So what we took from that is actually, yeah, those two products have very clearly different risks. One has investment risk, the other does not. So we could imply then that lots of general insurance products can be aggregated at a level above the product level because our products do not have such distinct risks. So what that means is that the managed together part of the definition becomes a key defining factor for how we define our portfolios. And this is an entity-specific measure because every entity manages their products, their business differently. And similarly, even in a group of entities, at the group level, we would manage it at a different level from, say, a subsidiary might. So at what level, so here, one of the indicators could be what level are key business decisions made. So for example, an indicator could be what level of granularity are your key reports to key business decision makers like the C-suite, the CEO, the CFO. At what level are those reports reported to them? So key KPIs, key decision-making reports. So that could be an indicator. And I might pause there and defer to Adam and Julia just for some insights about what they're seeing, where they're seeing people are landing in this industry around numbers of portfolios and what factors really influence that.
Go on, you start.
I think it's an area where everyone is still working through it. I think somebody said yesterday, where people started on this, it was people were worrying about needing 1,000 different group portfolios and that type of thing, and people have sort of built back up again from there. It's quite an interesting one because some of the language isn't that different to what we currently have, and we know that in Australia the interpretations at the moment are incredibly high level. And hearing Rachel talk about information that goes to a CEO, there's plenty of insurers out there that claim that's one portfolio, and the CEO only sees it on a combined basis. But everyone knows that there's sort of one level there, and then they get probably do see more granular than that. So. All of this guidance is, or sort of all the words, we can read them, but it really is interpretational, and I think it's one of those areas that everyone's waiting to see what others do. Because as I say, I don't think it's easy, and clearly it can have a difference on the way the numbers end up being reported. So.
Yeah. And again, the big consideration why this is important, because it does have operational implications, because we do have to be able to have data at that level to do our balance sheet disclosure, asset versus liabilities.
Would the concept of product lines be different for the insurance?
Yeah, possibly. Some people might choose to split facultative from treaty or even proportional versus non-proportional. Again, it's a business decision about how you manage your contracts.
And I think in some of those cases, the actual risks are probably more different as well between the nature of the contracts, whereas certain GI contracts maybe are more similar. So it's sort of, you've probably got that element of it as well. Does anyone else have any views on where they're...
So I guess the other interesting thing is where you might have some whole of business reinsurance held, which covers more than one growth portfolio.
Yep.
Yeah, good point.
Does anyone else have any thoughts on this one? And obviously, part of the discussion yesterday with APRA as well was around the typical APRA product groupings and where they currently are and where APRA land and what they want in terms of reporting and how that might differ or not from how the companies are interpreting this.
I've probably seen you starting at sort of short tail, long tail, and then within short tail splitting by just typical product lines, you know, motor, home, you know, contents insurance, that kind of thing. So it's actually not too different to how people are doing it now.
In relation to group perspective and local perspective, what are the challenges in terms of how they could be considered applied? Is it simply that you can aggregate up from the subsidiaries, or do you have to do a different assessment?
I think the group has to assess, obviously, at the group level, and so I think it's more, I can't imagine the group, although I suppose it's possible, and actually these guys work for a complex group, but I can't see there being too many examples in terms of the managed together, where you were saying that Australia should be aggregated with, you know, the US, and you should be aggregating what you've disaggregated in Australia and re-disaggregating it with a different country. So I can see it just being a more aggregated view once you get up to a group, as opposed to it having any sort of increased complexity.
Yeah, because each component will have to do their own, sort of each stat entity will have to do their own assessment anyway, and then obviously that will feed up.
Yeah, it's particularly important where you have local statutory IFRS 17 reporting, in terms of there will need to be an assessment there around the portfolios versus a group assessment if your group's in Australia.
More that of the lower levels will be doing it, the subsidiaries will do. Say you've got a huge global group, they might say, oh, they do APAC as one area rather than Australia, New Zealand, etc.
Yep, exactly.
Will you have differences between local and your group reporting?
So the local entities will have to assess them based on how they as an entity manage their business, obviously, because it's there for their reporting. Obviously, the ideal situation is that what they then decide is a lower level aggregation, which nicely adds up to what we have at a group level. So, for example, say in your example we had 8. Say we've got Asia Pacific as 1. Say a country like Hong Kong can't say APAC is their portfolio. Clearly, they have to say we manage as Hong Kong the business this way. Therefore, we have 6. So ideally, in that example, it clearly does. The 6 would add up into that one of the 8 for the group. So that's kind of how, in practice, we think it will probably work.
And I guess where the industry is heading on portfolios as a whole, in terms of the treatment of portfolios for the liability adequacy test being at quite a high level of aggregation, it does feel that there is some push to a hopefully slightly lower level of aggregation than that.
Is anyone from a global group and hadn't received any guidance from sort of parent entities on how you might be required to report?
I'm
Good
Alia,
Roger.
but yeah, we're starting to get guidance now, but their interpretation is probably still in its infancy, so we're giving feedback on that.
Yeah, I had heard maybe 12 months, maybe more ago, a couple of the global groups trying to do it at a very high level, and there being some shocked faces locally that just wouldn't fly locally. And so, yeah, I haven't heard sort of anyone determining a sort of final result that a really aggregated view was acceptable. So.
Yeah, and I think conversely, in some parts of the world, there's been some. I've heard 5,000 or something once mentioned.
Yeah.
So I think people need to converge on a sensible outcome.
Somebody's asked a question about APRA, but I'm not clear on what the question is. Does anyone brave enough to put their hand up or shout it out?
What was the question?
It's around inconsistency about managing portfolios and what happens if APRA comes in with a different level of aggregation. But I think that leaves us more closer to how we are now, where obviously the products are broken down for APRA reporting in a different way to how most people do their financial reporting.
So the bigger impact there would be how they make us look at losses for APRA reporting versus ASB 17. And Chris, we can probably talk about that when you get to how we identify onerous contracts.
Yeah, sounds good. Okay, so the level of aggregation and how it impacts onerous contracts identification. So I'm going to talk about this in the context of the premium allocation approach. And Rachel covered portfolios and them being similar risks managed together. Now, the premium allocation approach says that we can assume there are no onerous groups unless facts and circumstances indicate otherwise. Now, this is tricky wording because what are facts and circumstances, and how often do facts and circumstances arise? And therefore, how many onerous losses are going to arise based on those facts and circumstances? So I was going to put this out to poll, but whether we do.
Do it as a question.
As a question, has anyone got any idea of what are the types of facts and circumstances that may indicate the existence of onerous groups within a portfolio?
We're looking at cost ratio and our operating ratios.
So key performance indicators that might come out of the management level reporting? Yeah.
Knowingly price a block of business to repayment rather than
That's right.
risk to the market.
That's right. So we might be deliberately writing loss leaders in order to obtain a market share within that area, or it might be to support another area of business where we're trying to grow a profitable segment. So those are two of the examples that I've pulled up here, one of them being management information, so the type of information that your senior stakeholders will view. This could be information coming from the business plan. It could be your key performance indicators, such as your combined operating ratio, and various other management information. We also mentioned there that we may plan to write loss-making business, and therefore we know at the outset that that's an onerous loss component. Or there might be observable market information indicating adverse trends within a particular product area, and that may lead us to, as an indication that there are onerous segments within that portfolio. I'll just cover an exclusion point in terms of regulation. So if we have a profitable portfolio of business as a whole, but within that portfolio we have a onerous segment, and that segment that's onerous within the profitable portfolio is only onerous because of law or regulatory constraints that restrict our practical ability to differentiate the price of benefits for policyholders with different characteristics. In that instance, we would not have to disaggregate that group from the profitable portfolio. I think Rachel might elaborate with an example.
So one of the, I guess an easy example could be, you say we can't price differently for male and female drivers. But then insurers might say, actually, but the two groups of drivers have different risk profiles. And because we can't differentiate between the price, we have to charge them the same price. One of those groups could become onerous for that reason. So what the standard says, if the only reason the group, that segment is onerous is because we can't price it, so we can't differentiate pricing between that and another group, and the only reason we can't do that is because law or regulation says we can't, then we don't have to split the male and female drivers into two groups, which is what we would have to do ordinarily. We would have to split that group that is onerous, take it out, measure that loss, put that through P&L straight away. What we can do is put male and female drivers together into one motor group or portfolio, wherever that sits. And if together they are profitable, even though you have got that little onerous segment in there, we're all good. It's a profitable group. But if together they are onerous, then it's an onerous group as a whole, not because one of those drivers are onerous.
So the real challenge is how do we assess onerous contracts, and how frequently do we do this? We've spoken about onerous contracts being identified based on facts and circumstances at the portfolio level. Okay, so you've got facts and circumstances. But what does this mean in practice? Well, I think what we're expecting to see is that we're going to need an auditable and repeatable process, something that our auditors will be satisfied with. And we also know that there are differences in measurement versus something that we're familiar with in Australia, which is the liability adequacy test. That's something that we can conceptualize in order to assess our onerous contracts. There are differences with the liability adequacy test. For onerous contracts, we're purely looking on a gross basis. And we also have to bear in mind attributable expenses and various things like that. We also have this tricky issue with annual cohorts. We know that we need to produce the onerous loss component based on an underwriting year or inception basis. But then how do we do that in practice is open for debate. If you're identifying facts and circumstances at a portfolio level, you might be looking at financial year information to assess your onerous contracts, or you may do that based on the LAT test. It might be where we align on a gross basis. But then you may have to make an adjustment in order to allocate that to underwriting year. Or do you build this up on an underwriting year basis? So these are the sort of challenges when it comes to this kind of tricky wording around facts and circumstances. What is it really requiring us to do? Or to the more extreme case, is it suggesting that we have an ad hoc discussion in a meeting room around what's onerous within our business, and then we ask the actuaries to go off and measure something? I don't know if that's going to be an auditable and repeatable process, but maybe it is for certain areas. So I think that's where the challenges really come when it comes to onerous contracts.
I think once you identify the onerous contracts, what sort of messaging do you think you're going to have to give to the market and to people in the business to justify why you have those onerous contracts? I think that's going to be a challenge and something for companies to think about, how you actually report that. Yeah. You don't necessarily want your accounting to inform your business decisions, or that's not necessarily the intention of the standard, but it's quite easy to see that happening once you're pulling out onerous loss components and identifying what those are. Sorry.
The auditors, are the Big Four aligned in terms of how you're going to audit onerous contracts and onerous contracts?
I would hope so, given I think it's. I mean, it seems without seeing it in practice, it seems relatively prescriptive. So I don't see why not.
I'm not sure formally whether we are or not.
Yeah, because I guess in terms of discussions, that like the industry is almost having to take a leap to align or to think about it in something like the liability adequacy test. That's something that isn't directly in the wording, is not clear. But one thing is, if you've got your premium allocation approach, essentially how that differs versus the general model is whether your unearned profit is sufficient. And so that it starts to relate very closely to the LAT test under ASB 1023.
Did you just want to touch on what implications the APRA product granularity could have on our statutory onerous identification?
That's right. So, I mean, we're talking here under ASB 17 of facts and circumstances being identified at this portfolio level, which can vary from entity to entity depending on what your portfolio level of aggregation split is. Whereas if APRA require us to assess onerous contracts at their class of business groupings, or so that they don't go across class of business groupings, that's potentially disaligning with the ASB 17 approach to identifying onerous contracts. So that might mean that we need to potentially do 2 assessments potentially of onerous contracts, or even allocate to that basis. I guess it depends on what comes out of APRA's conclusions there.
The other possible consideration is also if your APRA classes are lower than your portfolios or the groups that you would have identified, then if you know they're onerous for APRA reporting, that's almost a facts and circumstance that it is onerous. So can you really ignore it for your stat?
Yeah, so I guess that leads to the how low do you go thing, and I think that was an earlier question as well, and I think someone mentioned yesterday that it's not supposed to be a witch hunt, and I've heard that at various forums in terms of this isn't intended to be, heading into the lowest level of grain in order to pull out your lowest grain of loss. it's very much that facts and circumstances at the portfolio level. So it's really that high level information that your senior stakeholders are seeing.
Does the standard let you split below the product level, below the contract level?
You can split it as granularly as you want. So you can have 2 or 3 or 4 or 5 types of onerous groups.
But I mean split individual contracts. Like, for example, if you've got a package contract.
Oh, okay. So that's a separation of contract question. So this was a clarification that came out in one of the TRG, which said that there is a presumption that the legal form of a contract is the lowest level of aggregation. So there is a presumption. So the legal form of a contract is your lowest. You technically shouldn't break it down unless, in substance, those separate components within a single contract are actually different contracts in substance. So you're basically just pasting 5 contracts together into one legal document. And there are a few factors we would have to consider in order to be able to make that assessment. So it's not that easy to be able to say, I can break my contract into 5 components because I've packaged them together. You have to be able to support that with evidence that in substance, there are actually 5 contracts pasted together. So for example, can they be purchased separately and sold separately? Can they be purchased at the same price? Are they interlinked with each other? So does one component depend on the other, for example? So these are no single one of those factors alone can justify splitting the contract, but it will be a combination of factors that you have to look at to decide whether it's 5 contracts in substance or 1. But otherwise,
And you don't get a choice in that, do you?
No.
If they are separate, then you have to separate.
Yes. Yeah.
I might just build on a point there in terms of the standard and how it asks us to group onerous contracts that have no significant possibility of onerous, and other. I think although we're talking, you set your facts and circumstances at the portfolio level, and then those are your indicators, and there you go and measure your onerous contracts. I think what the standard is quite clear on, and what it doesn't want us to be doing is diversifying when we come up with that assessment. So if a group has no possibility of being onerous, that's a very profitable segment. And so if you're building up your onerous contract measurement and your loss component, they don't want you to be diversifying and using the benefit of that profitable segment against a loss-making segment, and therefore you end up with a profitable group overall. So I think that's how you can interpret those kind of 3 buckets in the standard of onerous, no significant possibility, and other, in terms of doing your assessment.
Can I just ask a question on those 3 buckets? So
Yeah.
previously you said the industry might go towards binary.
Yeah, so I think that's more for, you're coming up with an onerous loss component and you're disclosing that, and then whereas the other part is not onerous, right? But I think it's good practice in order to be, when you're measuring your onerous loss components, that you're not diversifying across extremely profitable segments with other segments. So I think it's sensible in that respect to split those out.
And is there much interpretation between when it becomes no significant rather than the middle?
I mean, no significant possibility of onerous. I think the reason the binary approach is being headed is because it's a bit of that's almost like it's got no chance of being loss-making, and that I think is only in probably some very limited areas. We can probably think of a few in general insurance products where they're pretty good loss ratios.
Yeah, I guess the other reason is also it makes no difference from a measurement or presentation perspective whether you break your profitable groups into very profitable or not profitable or not. As long as if you identify your onerous contracts, everything else is measured and presented exactly the same.
Yeah. So it's more on that side.
I think it's just worth pointing out as well, and thinking about it, we are looking just at the gross side here, aren't we? So whether something's got a risk of being not onerous is obviously quite different to how you really normally think about it with your reinsurance in play as well.
And I think you'll be covering some of those at the reinsurance, or some of the relation to reinsurance.
For reinsurance, the grouping considerations are exactly the same as this. So we can apply the exact same rules. The only difference is reinsurance contracts commonly are one contract covering probably 5 different categories of gross products. So And then I guess that's where your question about this, can we split that one legal contract into components, becomes quite relevant as well. We do get lots of questions about, can I break my reinsurance contract so I can align it with my gross portfolios? Well, for a reinsurance contract, probably not, because it's probably actually one legal contract covering 5 different risks. So that matters. So you can't have 5 portfolios for that one reinsurance contract.
Okay, I think in the interest of time, shall we move on to?
Yeah.
Or was there another one?
Sorry, another couple of questions.
Yeah, sure.
The big one being, so how do we measure onerous?
So I guess that, I mean, if we're thinking about, it depends on how you approach it in terms of your facts and circumstances. I think if one of the ways I like to think about it is in terms of the liability adequacy test and the sort of information that feeds into that. Your planning information in terms of your combined operating ratio. For example, if you've got a segment that's greater than 100% combined operating ratio, that's obviously profitable. You may build it up based on your planning components there. But importantly, reserving information is going to need to feed in. This is an inception-based test, but if we're heading to an approach where the unearned premium becomes important in this test, then the reserving assumptions, what's already been written, those assumptions will feed into your assessment. So it's the usual things in any valuation, in any measurement: history, the business plan, and what you expect to happen in the future.
I'm just going to go one step back and say what the requirements are, which is your contracts are onerous if your present value of future cash flows is a net outflow. So that's how we measure onerous loss. The present value of future cash flows relating to your future coverage, what that net outflow is, that's the loss. It's the same under both the general model and the PAA.
Thanks. There's also a questioner here around whether the industry, FSAA, or even the Big Four are engaging with APRA on the product aggregation they want to see. And so APRA did say yesterday, or in their session, there was an opportunity for the insurers and consulting firms to respond to APRA. I think the deadline was last week. They did say they had was it 12, 16 responses? I know some of those came from Big Four. Others obviously came from insurers. And so definitely they're seeking constructive feedback. They don't want to just be told, we don't like this. They want to know, well, how else can we achieve what we're trying to achieve, and make it sort of, in the best way for the industry. So absolutely, the insurers and the accounting firms are working with APRA, or certainly providing input into APRA. That's it for this section.
Do you want to take?
Yeah, I'll let you guys take a seat.
Do you want to stand?
Yeah, I'll let you guys sit down.
Oh, you're good. I'll just stand here.
So moving on to KPIs, and what I just wanted to cover is what they look like in the current world, and then what we expect them to look like under AASB 17, and how we're going to have to evolve those measures to meet new requirements. So just an easy start, just using the polling feature. Overall, which of the following do you think are currently the primary KPIs within your organisation? So we've got on there GWP, claims experience, insurance profit, net profit, cash earnings, or capital strength. Appreciate there's probably more than one, but just going with primary.
Just checking everyone's still awake, so pick up your gadgets. 12 of you.
Oh, wow.
Oh, this is awesome. Yeah. Well, we're excited.
It's only taken an hour and a half to get it working.
Yeah.
We can't lie this time with the responses.
Yeah.
The order is chicken, it adds up to 100%.
Keeps moving.
Yeah. I think that's actually probably when I was thinking about it earlier, how I actually see it, that insurance profit, especially when you go to AGMs and investor presentations, is really a key focus, and it's really the bread and butter, obviously, of what insurers do. And when you think around, when I go out and have conversations with people in the business, that's where the interesting conversations are. And, if you speak to claims advisors, underwriters, I think the lens, the way they currently look at the business, it's quite easy to reconcile that back to the financial statements and KPIs as they currently are. But if we think about the future world and, you go and speak to someone in the claims team and you go, well, how do you get back to that? What's it called? Insurance service cost? They're just going to be like, what are you talking about? Probably most of them. So I think probably just go back to the main slide now. But yeah, I think the result is pretty much in line with what we'd expect.
Interesting, I guess the short-term view and the capital strength falling really low in the listing.
And I think as Adam said at the beginning, I think it's probably pretty rare for any company to just have one. And whilst I fully agree, most of the clients I work with, insurance ratios and insurance profits are very important. I think there's definitely elements where people look very much towards GWP from a sort of growth perspective. That top line growth, the sales number in other industries. Somebody agrees. They just agrees with that one. I think a number of these are important at the moment, and so as Adam says, there will really be a difference when we don't see some of these, and particularly something like GWP anymore. So yeah.
Could you just go back to the slides, please? Thank you. So yeah, I've put some KPIs up there, but what I've also brought in just to get a different perspective is, so KPMG performed a survey on a number of analysts just to get their views in what they felt was most important when assessing an insurer's financial performance. And what actually quite surprised me in here is actually only 21% of respondents felt that an IFRS measure was the most important metric when measuring an insurer's performance. So just to explore that, I mean, I've gone to the poll, but really just keen to discuss why people think that's the case. So if we think, is it a lack of comparability between insurers, that they're just going, these IFRS measures are just, I can't compare between the two. Particularly if you think around things like even risk margins, you can have different insurers using different risk margins to arrive at their results. Transparency and understanding of how the insurer actually gets to those numbers. So again, do vote if you can, but just really keen to discuss those points and get people's views.
I think important to note here, it's a global survey, and so obviously without a global consistent approach at the moment, in my mind, that lack of comparability has clearly got to be part of the issue, because an insurer in one jurisdiction is currently reporting the same results in a very different way to an insurer elsewhere.
So we'll be keen, just do that vote just to get people's views on that.
And this is current IFRS measures, isn't it?
Yeah.
Rather than prospectively for IFRS 17.
So we're at 58% saying lack of comparability.
Yeah.
Only 17 on lack of understanding of insurance metrics. I think there was a bit of discussion yesterday that there are analysts who do understand insurance, and there's lots who think there's a black box somewhere involved and they don't really understand what comes out the other end. So I think there's definitely a number of the sort of generalist analysts who might be coming into that bucket, but I think also there's a lot of very, very skilled analysts who clearly do understand the insurance metrics. So yeah.
Okay, thank you. So then I'm glad that the comparability point was the main one that was voted for, so it leads nicely on to the next question. So do you think IFRS 17 will lead to improved comparability of financial information between insurers?
This will be good.
The first answer is no.
Very fast as well.
It's a very quick no. Just about with a yes, but it's pretty close. Oh.
It's interesting, yeah.
It's quite exciting watching this.
Yeah, that's quite spread.
I mean, in favour of yes, when we think globally and cross-border, it's got to improve it, right? I mean, even for myself, coming from the UK, the way the financial statements are set out in the UK and then when I came here is quite different, particularly even when you think about the outstanding claims liability. So the risk margin concept in the UK is kind of wrapped up within IB&R. It doesn't exist. So, even for myself coming here, I was like, what is a risk margin?
Yeah, I went through a similar journey as well. Even discounting, I just had no idea what that was all about.
So yeah, I think from an analyst perspective, and it's got to help, right? It's got to make them more comparable. And then you also think, even locally, we have GI, life. You know, surely having one way of measuring all this is going to be easier.
Can I ask if anyone's brave enough to say why they don't think there'll be improved comparability?
That's fair.
Is that what led to a no?
Yeah. Yeah.
But within the IFRS reporting countries, do you think? Yeah. Cool.
Yeah.
Okay, fair enough.
As well, that some even composites are going to be talking about life and GI separately and not bringing it together.
There will also be a lot of subjectivity in the assessments.
That's the risk I see.
Yeah.
It will be very difficult to understand the basis.
Yeah, definitely.
It's come through today, even that there's still quite a lot of interpretation and subjectivity and how people are going to sort of produce their numbers. So, yep.
Okay. Last part, I promise. Do you think general insurers' KPIs will notably change due to the implementation of IFRS 17? Which kind of leads nicely into the next slide where I explore that.
Expected this one to be divided. Yeah.
So I guess that really is dependent whether you fall under the PAA or general measurement model as well, right? Because that's going to have a significant impact on, you know, how you recognise your profit over the life of a contract. So that's probably, I think if you fall under general measurement model, it's fair to conclude it's probably going to be a yes. Okay.
And then there's questions around whether items like GWP will fall away or whether they remain important for assessing how much you write year on year.
Okay, thank you. So on the next slide, we have, so I've kind of just tried to put into a picture what the new KPIs might look like under 17. So obviously you have a group lens and then the individual insurance divisions lenses. But I guess the first thing we need to ask ourselves is the way we currently do KPIs, are they fit for purpose or are they going to need to adapt under the new world? And clearly there's a mixed view in the room, but when you think of things like people's bonuses are heavily linked to KPIs, you know, you really want to get in there early and start to understand how your KPIs are going to be impacted by the new standard. Or you know, if people start getting smaller bonuses, I think there's going to be a lot of noise in the business. And then how do people feel about having to communicate and educate stakeholders on the new KPIs? Has anyone sat in a boardroom or with senior management and tried to talk about the new standard? Have you guys had any experiences with that?
I'd say the increasing engagement at the moment from.
Yeah. Because when you think about a lot of your boards, not all of them always come from an insurance background anyway. So, you know, I think they kind of get the standard as it currently is. They can go back to premiums of your sales, claims of your direct expenses. But, you know, in this new world, talking about service margins, I think it's going to be tough.
I think audit committees are probably starting to get interested, is that fair? But they are starting to ask questions about what is this going to do with my financials? I guess that's the first obvious question, isn't it? About before KPIs, it's what is it going to do to my P&L?
And look, also supplementary measures. I know some of the clients I work on have already said that in their investor presentations for the first couple of years, they're going to be able to help reconcile back to the old world because they really don't think people are going to be able to get to grips with how it's changed. And I think we will see that, and I think that will come out in financial statements as well, in a lot of the notes where people are going to try and help the users get back to at least reconcile to how it looked in the old world. And then finally, I've put in the point there that actually it could make insurance even less attractive for investors because they might just really have no idea what's going on. Does anyone have any comments on what they think the new KPIs might look like?
I think someone said it quite neatly yesterday in terms of this is probably something that's going to evolve over time as the standard comes into play. And I think getting your buckets right first and getting your financial statements and what goes in there right first, as we get industry convergence, I think we'll start to evolve in how we represent those key performance indicators in the future.
And I think as soon as companies start having more of an idea of what their financial statements are going to look like as well, and what information is in there, and then obviously the KPIs, you often want them to reconcile back in some way to what's reported in the financials.
That's right, yeah.
Whilst everyone's starting on the actual sort of the nuts and bolts of how it all comes together until you see it, it's a bit harder to know what you're going to actually measure.
Okay, so that's it on KPIs. We've got a bit of time now, and this slide was in there yesterday during the APRA presentation, but really just wanted to highlight that what APRA have proposed, and they are open to discussion on it, is waiting an extra year to implement the standard in terms of their form. So, I mean, from my perspective, I'm not criticising that decision. I don't have a strong view on that decision, but for me, what comes to mind is people are already going to be doing a parallel run for up to a year. So if you think you're running 2 ledgers for up to a year, the year before implementation, and then you have another year of running 2 ledgers because you have to do that for APRA purposes. My concern is that we all know there's not enough resource for this in the industry at the moment. How much of an operational and resource burden is that going to have on you guys? So please do offer some views, because I don't, or if APRA in the room, definitely give some thoughts. But I really just want to open it up because it's not for me. All I can say as an auditor, I see how much crunch there is on the year-end process. So having to run 2 ledgers, how do you feel about
Exciting.
Give me more.
And had that APRA have been implemented at the same time, had their returns been at the same time, would you feel nervous around your Q1 that would be unaudited? So lodging information with APRA in Q1 that was not audited, would that make you nervous?
I'm sure APRA will be very sympathetic to us.
Okay.
I think we all know, this is, we're actually looking at an 18-month period.
Yeah. Yeah, thank you.
Yeah, I'll agree with that.
It'd almost be useful if APRA agreed to sort of doing a staggered approach. So you report 1 month and then have another month to do the other on the basis. Almost. So what we put that feedback into APRA.
Yeah.
And if you were here yesterday, they are very much seeking constructive feedback. So I think there's a lot of information that they need. Obviously, it's not going to be easy for the insurers, but if anyone's got constructive feedback as to how they can achieve their objectives without being as disruptive as it might be, or as challenging. And also that obviously we're aware of reducing some of the risk around trying to rush through 2 lots of reporting in one go. So do feed it back to them.
Okay, so if there's no more questions on that, maybe we could just, I think we've got, literally 2 minutes, but any more questions just on the overall, obviously, for Chris and Rachel, who did all the technical hard stuff?
It's been a very long session, so we might wrap it up there.
Awesome. Everyone's ready to apply IFRS 17.
Thanks very much, everyone.
Thanks, everyone.
Thank you for your time.